Okay, so another one of my favorite childhood companies. Today, we're going to take a look at the world's largest video game publisher, Activision Blizzard. What is your experience with Activision Blizzard? I think they have touched everybody at some stage. 15 years ago, maybe it was Guitar Hero or maybe it was World of Warcraft. Even my mum plays Candy Crush. Just like my previous video on electronic arts, my inner childhood really wants me to invest in this company, but let's go analyze it properly. If you are new to my channel, well, welcome. My videos are about investments that anyone in the world can make. The average age of a US gamer is 35, and the average number of years a US gamer has been playing games is 13, and only 29% of the gamer population is under 18 years old. This blows my mind that the average gamer is 35 years old. When I think of computer games, well, I think of my childhood, but these companies are not selling to children. That isn't the market at all. It's mostly male and it's mostly adults. And the good news here is that adults have money and this hobby is big business. The other stereotype is that video games are antisocial, and in my opinion, that couldn't be further from the truth. Today, gamers gather from all over the world in online worlds to socialize and to play. It's also one of the most inclusive hobbies that I can think of, and it's accessible to people from all over the world. And as 5G technology starts to roll out across the world, well, more people for the first time will be getting access to the internet and high speeds at that. So the gaming industry is going to benefit greatly. So gaming is going to get better and better, and I think the future looks really bright for the industry. Now this might sound strange, but I don't see many big threats for Activision Blizzard. Of course, the competition is strong, and even some of the big tech giants like Tencent and Google, well, they have large stakes in the gaming world now. And then you have the other rival pure gaming companies like Electronic Arts and Take-Two Interactive that are also strong competition. But I think there's a place for all of them because the industry is growing so fast and Activision Blizzard already has decades of experience. So I actually think the moat around their business is quite high because it would take hundreds and hundreds of gaming developers to compete against the quality games that Activision Blizzard can produce. Look, of course, they're not a monopoly and I know their moat isn't perfect, but I do think it is quite high compared to other industries. Okay, so from a purely financial standpoint, the business model behind Candy Crush is brilliant. But I do have an issue with Candy Crush. Their freemium model reminds me a lot of slot machines. Now, I'm going to let the Canadians explain how the Candy Crush freemium model actually works.
Allow me to explain the science behind micropay freemium gaming. With mobile apps, we now have the ability to make games that are boring and stupid. If you pay for incentives, you're rewarded.
Freemium. The meum is Latin for not really.
It's a simple cycle, a never-ending loop based on RPGs. Those just use the concept of XP or experience points. We've introduced the idea of micro-paying with money.
It's what everyone is doing. Freemium games are what's now, and it's all just a lot of harmless fun.
The problem that I have with Candy Crush is there's actually a scientific percentage of the population that is very vulnerable to the dopamine release in games like this. And out of these vulnerable people, the game becomes far more addictive. Approximately 2 to 4% of all users who play Candy Crush actually spend money in the game, and a small percentage of those spend over thousands and thousands of dollars a month on Candy Crush in-game purchases. I know that seems like bad self-discipline, but it's actually out of their control. So my friend's father spent over $2,000 in less than 3 months in in-game purchases in Candy Crush. He thought the small micropayments were too small to even worry about, but because he was addicted, he just couldn't stop. Look, this is my personal moral opinion on Candy Crush. Look, I wish Activision Blizzard didn't buy this company, but they did. So in 2016, they bought King Digital, which is the makers of Candy Crush, for $5.9 billion. Now, Activision Blizzard were able to finance the deal with a lot of cheap debt, and they added a really profitable business into their portfolio. In 2020, they're not going to be that far away from making $1 billion in income a year from Candy Crush. So from that financial point of view, it has proven to be a fantastic investment. Okay, now let's go talk about the great parts of the business that I actually like. Call of Duty and StarCraft have been big drivers of the esports revolution. Esports is growing rapidly and Activision Blizzard are right in the middle of this revolution. If we are looking for an investment thesis, we don't have to look much further than this. Call of Duty is the best-selling game in the world right now and its 7th most popular game of all time. And with the new version to be released in early November, well, that seems like a very positive catalyst. Okay, now I bet no one had played the obscure game called Earthworm Jim for PC. I loved this game as a child because it was super random, and I just remember still seeing the Activision logo on the title screen of this game. And if anyone out there is actually familiar with this game, please let me know in the comments. But here are the actual popular titles from Activision Blizzard. We've got Call of Duty, Crash Bandicoot, Guitar Hero, World of Warcraft, StarCraft, Candy Crush, and the list goes on. The company actually reminds me a lot of Disney. They create and acquire a blockbuster game, turn it into a franchise, bring out spin-offs, and profit handsomely from their additional titles. So the gaming world is moving towards more of a Netflix-style subscription-based model and with in-game purchases. And with more people spending time at home in 2020 and potentially 2021 as well, Activision Blizzard seem to be one of those companies that's going to benefit from these strange times. And we can't forget about the esports revolution that is taking place, and that's going to be a big driver of revenue in the future. Now, with any business, to check the financial health of the company, we need to look at these three areas. We need to see whether they can handle their debt, are they growing, and are they a well-managed company? Now, don't worry too much about the terminology here, just sit back and just get a feel for what's going on. It's probably more of an art than it is a science anyway. It is so important to look at the company's debt because generally speaking, businesses that don't have any debt, well, they can't go bankrupt. Debt has always been the number one reason why companies get into trouble. So to see if the business can handle its debt, I went through the debt to equity ratio and the current ratio of the business. Now I want to see the debt to equity below a 0.7, and Activision Blizzard is well under that. But when we go take a look at the balance sheet, we see half of the assets are in intangibles like goodwill. Now, I don't like seeing a company with this much goodwill because it appears that the debt is more manageable than it actually is. So we definitely want to go see the current ratio, as that won't factor in the goodwill, just the current assets and the current liabilities. And fortunately, the current ratio looks really good, far above my preferred 1.5 number that I look for. So we can give them a tick here. In the finances, to check for growth, I look at the book value per share, the earnings per share, the operating cash, and at the moment, I like looking at the gross margins as well. Sure, 2020 is going to be a bit of an exceptional year, so I want to think about that when I'm looking at these charts. This is the book value per share, and it's a solid growth here from Activision Blizzard. This is the earnings per share graph, and as you can see, there was a fall in 2017, but we've seen improvements since then, so I think it's not a problem here. Now, this is the cash generated from operating activities, and well, there's not consistent growth, but overall it has grown since 2015. I think we can move on. It's not great though. So like I said, gross margins is something that I've been looking at more lately because a company that can grow their gross margins is doing a lot of things right. And Activision Blizzard has recently been growing their margins, mostly this year, so that is a good sign. Now, we can't just go talk to the management team and sit in on their meetings to make sure they're making some good decisions. But there are some telltale signs in the financials that tell us whether management are making some good decisions. So I check the return on equity, the free cash flow, and their cash on hand. Now, I want to see the return on equity number above a 15, as it shows management are improving the value for the shareholders. Now, there is a bit of a trick here. So with that big goodwill number that we saw earlier, remember? The return on equity is going to be off here. What we actually need to do is work out the return on equity, but not factor in that big goodwill number from the balance sheet. And to do this, we want to find a number called the return on tangible equity. And for Activision Blizzard right now, it's currently at 77%, and that is actually really, really big. Now, this is the cash that they have in the bank, and as you can see, it's been improving since that Candy Crush purchase. So that's all I really want to see. This is the free cash flow, and I can see general growth here. I'd prefer to see the growth over the past 2 years, but generally it is heading in the right direction. Look, they do pay a small dividend, which I personally prefer it if they didn't, but it's very small anyway. So overall, pretty solid financials here from Activision Blizzard. So now it's all going to come down to the valuation. Now, if you want a copy of the intrinsic value calculator that I'm showing you right now, well, it's free and it's in the description. So let me go through quickly with you the inputs that I've used for this calculator. So the growth rates that I use now, I had to go and look at different analysts' opinion and my own opinion as well. And on average, I think it's going to be about 16-17% for the next 5 years. So I've used 17%. Now the growth rate from years 6 to 10, I think it's going to reduce just because that's what happens as companies mature. Plus, look, that's a long way away. So we have to be a bit conservative. So I've used 17, 12%. Now the discount rate, now we're trying to find the intrinsic value, not what we're going to buy it at the moment. So I've used 8.5. This is just rounded it to 9. The multiple I could sell it for, this is pretty standard PE ratio for the gaming industry of about 18. The free cash flow number that I've grabbed, well, I normally would get the operating cash flow minus maintenance capex. The free cash flow was just a lot easier to find, and that's what I recommend you do as well. The shares outstanding is here, and it says I want to buy I want to buy it at $98. Now, that's not what I actually want to buy it at. That's intrinsic value, remember, because we used 8.5%. So let's call that $100 is intrinsic value. Now, I want to get a good margin of safety. So what I would do is I could just halve that number. So I said $100. So $50 would be a great entry point. That would give us quite a big margin of safety, something that I'd be looking for. Now, let's go check the actual share price right now. Now, I've just gone over to Yahoo Finance, and the current share price for Activision Blizzard, well, as you can see, it's about $80. So what I've done now in the intrinsic value calculator is I've changed the discount rate from 8.5 to 18%. And that's given us a buy price of around about that $50 mark that I said. So look, normally I'd like to have this margin of safety even a little bit more than that. Let's keep it at 18% for now. $50 is probably a pretty good price if we could ever get it. But like I said, the share price right now is $80. $50 is a long way away. Now remember, this is just my estimations. Play around with the different growth rates. If you think things will be better than what I think and what the analysts think, then try higher growth rates. Now just don't forget the margin of safety, because no one is going to be able to predict things exactly. So you just need some breathing room for errors. So do I want to invest in Activision Blizzard? Now, like I said, I'm not buying them today, and I'm probably not buying them anytime soon. We need to see about a 40% drop. So I'm just going to put them on my watch list because they are a great company. And look, if I never get this price, I'm totally okay with that. I have lots of companies in that watch list. So I think the future is really bright for the company. They're in a growing industry and their financials are solid. But I don't like Candy Crush, and that's more of an emotional, moral issue for me. But I think for most people, it is a great investment at that $50 mark. Now, fortunately for me, so I don't have this dilemma, I don't think we're going to see that price anytime soon anyway, so I probably don't have to worry about it. Now, I'd love to hear your thoughts on this investment, because I know a lot of people are going to think that Activision Blizzard is a fantastic company and a fantastic investment, and I'm just being far too conservative. Please hit subscribe so you don't miss any of my future videos. I hope you enjoyed this analysis, and I will see you next time.